Welcome to MF3P's Did You Know series. Our goal is to inform and educate. Today, we're going to be talking about mortgages. Dean Rathbun and I have been working together for about 25 years, I think now. Okay, so just a couple of years, a couple of hundred transactions. We're going to be focusing on the mortgage rates and how they affect primarily first-time home buyers. As we've discussed in previous episodes, a successful strategy in home buying is first to determine the budget, second to determine the neighborhood, and third to determine the structure. What type of structure best fits you, your personality, and your experience with home ownership. With that being said, Dean, why don't you tell us a little bit about yourself?
Thanks, Mike. Well, so this is my 35th year doing mortgages, so I'm dating myself a little bit, but I go back to 1988 when I did my very first mortgage. And all I've ever done is residential mortgages in really my adult employment time. And I love it. I mean, I love the business. Each file is an individual puzzle, and I like putting the puzzles together and helping people. So it's something that's just been extremely fulfilling to me. And I enjoy it. I don't have any other idea of what I would do besides doing this, because it's great. It's a great fulfillment to me.
Yeah, in our industry, passion and just the enjoyment of serving really does help us to get out of bed in the morning. And when you get that face on that family when they get into their first home, it's just the most rewarding thing that you can ever experience. Where are today's rates versus historic rates? You said that you started back in 1988. I could only imagine what the rate was back then.
So when I first got in the business, 1988, interest rates for fixed rates, we'll just compare fixed rates right now. Fixed rates were hovering around 12.5%. That was an average 30-year fixed rate at the time. Today, interest rates are in the high sixes to low sevens, depending on the type of property, the type of mortgage, the amount of down payment, the FICO score for the individual. So many different factors come into it. We often get phone calls. Hi, what's your rate today? Well, I just need 50 questions answered. And maybe
one or two, right?
Yeah, it's not that many, but you must have more information than that for rates, because there is quite a variety of them. People think interest rates are high today. I disagree with that statement as high. Interest rates are higher and just a touch above norm, because normal rates are in the 5s and 6s. Today we're in the 6s and 7s. We anticipate that coming down probably in the next 12 to 24 months as our estimate right now, just based on past economic factors and things that we've seen. And 2002 was the last time that rates were what they are today. So actually not that long ago.
Well, it's very interesting. You come up with the very specific rate is based on the actual property and the length and the actual homeowner or the person applying for the mortgage rate. Right. One of the things that I always found confusing until I got into the industry is what's the difference between a rate versus an APR?
Yeah, so a mortgage interest rate is the actual rate set on the note. That is the amount that the loan is calculated at to determine the payment. It's a set number. So that's the mortgage rate, interest rate. The APR is the cost of that credit over the life of the loan. So APR includes points, fees, prepaid interest, and it's also amortized and anticipated over that whole, traditionally 30-year mortgage time period. It also includes mortgage insurance. So FHA has upfront mortgage insurance premium. It has a monthly premium. Conventional loans with less than 20% down oftentimes have a mortgage insurance premium. So that is a cost of credit, right? It's a cost to get that loan. Your monthly payment's higher, therefore the APR is higher. And VA loans, same thing. You have a funding fee oftentimes on a VA loan. So that will increase the amount of the loan, which of course increases the cost of credit. So the APR is just a guide to kind of help. Now, let's just say we went out today and we're looking at a conventional loan, and today the rate is 7%, okay? And it's at no points. Well, the APR on that maybe at about 7.12% on a rough number, because there's no points. There's nothing to buy the rate down. The fees calculated in that are really the interest plus some of the other closing costs to close. Now, if you had mortgage insurance on that same loan and you paid 2.5 points to get that rate, now that cost of the credit went up. So that APR over the 30 years may be 7.21%. And that's how you compare cost of a loan. So oftentimes people will look just at the interest rate versus looking at the cost of the loan or the cost of the credit over time. Right now, we're a big advocate on doing 0-point loans because we anticipate interest rates going down in the next 12 to 24 months. So if you were to pay a point right now, it takes anywhere from 4 to 5 years to break even on that point. Chances are those who will finance today most likely will refinance in the next 12 to 24, 36 months. So that cost of buying down the interest rate or buying down the point probably isn't the best effective use of money right now.
Well, it's very interesting. You brought up the difference between the two different numbers. How accurate are these online calculators and website estimators?
They're a good guide. You know, you're at home and you're looking on the internet. Everybody does. We're on your website. They're looking at properties on your website.
Yep.
You know, we have calculators on my website where they could be looking at a listing you showed them, and they can go into my website and then plug in. If I do a loan amount of $675,000, you know, and I know that the rate is roughly X because I've talked to Dean and he told me what the rate is. You can play with that number. So maybe if you want to do a loan of 675 versus 600 versus 650, they're very easy to toggle and to run those numbers and to see the different quick calculations. Now, what you got to be careful of on some of the calculators, and my site has them, you know, what do I qualify for? Well, there may be other things that you don't take into account as a consumer, that we do look at. Sometimes they're self-employed people that go, you know, my gross income is X, but my net reports is X. So the calculators, you know, can be skewed a little bit as far as what the actual true qualifying amounts are. And that's why we get heavily involved in the actual numbers and ask the questions from that aspect. But they're a wonderful guide to be able to determine what the principal and interest payments can be, because remember, it's amortized interest, right? So it's compounded interest over time. And it's really impossible to kind of do on your calculator unless you know the money factor of it. So that's why they're very helpful.
I know a couple of the deals that we did together over the past few months, there's a significant difference between a single family home detached versus an HOA condo policy. So there's a lot to it, which brought up another question. And we're speaking primarily with first-time home buyers in that particular case. What's the big difference between a mortgage broker versus going direct to the bank and lender?
So there's actually 3 models, right? There's a broker, there's a bank that you go into, and there's mortgage bankers, which we are. So a broker is someone who doesn't fund the loan. They arrange the loan with various banks or investors. They never fund the loan. They don't draw the loan documents. They have no authority in the file in any capacity. There's a bank, you know, a traditional bank, brick and mortar bank that you walk into. And a lot of people feel, you're my bank, so therefore you should be my lender. And they walk in. Well, oftentimes they're not quite as competitive or may not have the array of programs that are needed for an individual. And what I mean by that is, if you're walking into a bank branch, the competition doesn't need to be quite as great. They don't need to be quite as competitive on their numbers, because they get a lot of walk-ins from people who don't know that there's better rates or opportunities out there. And they just figure, you're my bank, I go into you, I get the loan from you. So oftentimes our investors that we have are much more competitive than the big banks. And our situation is called a hybrid. We're a banker and a broker. So we listen to the client, we analyze their need, we find out what is truly going to be the best program for them. FHA, VA, no income documentation. Maybe they have a lot of assets but don't have any income. Maybe they are a perfect Fannie Mae candidate. Maybe they're a super jumbo. So we've got an array of over 50 different investors who buy money from us. So what that means is they go out and say, Dean, this is the product set that we have that works. So it's our job in that capacity to listen to the client and determine which loan is going to be best for that particular person or family's needs. And then we place that loan, either we close it and then they take it off our hands and service the loan, or we give it to them and they actually fund the loan. So that's a hybrid. We can both close the loan and bank it and close it, or we can do it as a broker basis. So you get the best of both worlds. It's the most competitive.
It's amazing, and really became very evident over the past couple of months. When you're working with one of our clients, there really becomes a relationship. Especially this past year, you had to make multiple offers for the same client. Back in the day, you'd be able to get one or two offers out there and actually secure a property. Lately, it hasn't been that way. And so the relationship and the service that you provide my clients, thank you very much. Much appreciated. And with a little bit of introduction to the complexity of it, now I understand why my clients are so happy with you. The question becomes, in today's higher interest rate environment, I'm going to date myself. I remember the first home I was involved in was 16.5%. So we're talking a long time ago. Isn't the question today really just affordability, of why somebody should rent versus own?
That's a big part of it. I mean, we can't kid ourselves from that aspect, right? I mean, you have to still be able to make the payment at the end of the month. So that's what we help families determine in the pre-qualification process right up front. But let's talk about real family or generational wealth is what I like to call it. If you look at the majority of families across America, the largest asset they have is their home. That's their largest source of their net worth to each individual household. If you have to make a payment every month to live, to have a roof over your head, you could be making a payment of rent to a landlord, which pays down his mortgage, which allows his property to grow in value and creates his wealth.
Right.
Or you can fight and claw your way to get your first home. It may not be your perfect home for now, but we'll talk about that in a moment. You get into a home and you start to build that same wealth. So the monthly payment that you're making is paying down a mortgage, while the value of the real estate's going up over time, creating your wealth. So a large majority of, and this statistic may change coming up now after 20 and 21 when the interest rates went so low. Most average buyers will own a home, at least in Southern California, for no more than 7 years. They'll either refinance and pull money out to do improvements. They'll move. There's other factors, job, divorce, death, that come in and create the need to have a mortgage refinance or changed. Mm-hmm. So 7 years is kind of an average number for that. Now, after the pandemic and interest rate going to these record lows, we'll probably see that statistic change some, because you had rates that were so low at that time that people will be forced, and not actually forced, but they'll analyze and just go, I'm not getting rid of that low payment that I have. So that statistic will change a little bit. But remember, on average, people will keep a mortgage for 7 years. So what that means is you are going to move into a property, and chances are you're going to move out of that property sometime in that 7 years and move up, especially for the first-time buyer. That number is exponentially higher for the first-time buyer or the first couple homes of a family, because there's always that upwardly mobile transition. Mm-hmm. As people grow older, incomes grow up, net worth grows. Your net worth grows of the rollover of the property that you bought, right? So the appreciation grows. You paid down the mortgage. There's more there. And as you know, and I'm sure you're going to touch on in another segment with a financial CPA or some type of accountant, right, they can roll over up to $500,000 tax-free, quote unquote, check with your CPA, for your owner-occupied sale, right? So if you live there 2 of the last 5 years, you have a $500,000 profit, you can roll that over to the next property. So when you do that, that is a wonderful way to be able to get into the next home. That happens as you build equity and pay down your mortgage and the property appreciates. Now, I always get it. What if the property doesn't appreciate? What if it goes down? Okay. Well, don't sell yet. Wait, it's not the time yet. So it's really about timing on all of those things. And over time, if you were to get a 2 or 3 or 4% return on a single family residence over time, that is a lot of wealth built over the decades. It's a large number.
Well, you bring up a bunch of very good points, and the thing that always sticks out when I'm talking to buyers and new buyers is, how do I get the down payment? That's the challenge that I have.
Especially today.
Yeah, in today's market, though, from my understanding, there are many down payment assistance programs.
We have a slew of them. Now, the down payment assistance programs can be for first-time home buyers or not first-time home buyers. They can be census tract driven. They can be minority tract driven. They can be income driven. They can be job driven. You can have assistants if they're in the medical profession, or teachers, or firemen, or all kinds of programs like that. So that is part of that product where we come out and talk to the individual. We hear, where do they work? What do they do for a living? How much they have for a down? Where have they lived? Are they a first? There's even a program right now if you're a first generation home buyer. So what that means is your parents never owned a home. So there's even more help for that. So there's a lot of programs, and we're constantly. I am on no less than 3 to 4 Zooms a week on different product sets that are changing. So that's, on average 12, 16, 20 a month that we go through with different product changes, different programs that come out, income based, FICO based. There's a lot of different products. So that is a large part of our business and requirement, is to keep up to date on the different programs and the different things that are happening. But there's a lot of down payment assistance programs that can be utilized.
If you could rattle off, what would be the top 3 or 4 biggest benefits to a first-time home buyer?
Well, I think you look at it depends where you're looking. So there's census tract mode. There's income mode, right? So income limitations will go up to 150% of median income. FHA, allows a 3%, a 3.5% down. Fannie Mae has a 3% down. There's grants as part of that 3%. The real key to that is, again, you have to have a roof over your head. So if you can get in with one of those programs to get into the property, and now you're making the monthly payment, your payment of the balance of the mortgage is going down. Over time, your appreciation is going up. You're creating that next step to the next house, that next step to the bigger house. So even if it's not the home you're thinking of in the beginning, it's a home that will build you net worth and net equity for your future dream. I mean, how many clients do we get that say, okay, I want to go buy my first home. I'm looking for a $3.5 million house on the waterfront, 4 bedrooms, 6 baths, and I have 10,000 to put down. I mean, it doesn't work that way. You go in steps in our business, and you build it. And so I think it's important to remember that just because you're buying the house, it doesn't have to be your forever home when you're the first time home buyer, or even your second home.
And those are a lot of the perspective that I'm getting for buyers right now. Hey, I'd love to have a backyard. We start going over the numbers. They start to look at their budget, their tax credits that are capable, even at a very small increase. And they're saying, you know what, I don't need that backyard for the first 2 or 3 years.
That's right.
And that's what's going to help them get into their first property. And once you get your first property, then the process becomes easier. Number one, you're more familiar with it. But number 2, you also have that equity to take with you and to move forward.
That's right.
I really want to thank you for the expertise that you bring to the table for this and for all my clients. Basically, us as real estate agents, there's 3 N's, I refer to them. Our network, our navigation, and our negotiations, our network of vendors, suppliers, and professionals like yourself, who allow our customers and our clients to really have a pleasant experience during the home buying process. The navigation of the plethora of documentation that goes through tax implications and everything else, and of course the negotiation skills. And you and I have spoken about that at length. I think that will also be another one of our topics coming up, will be the negotiation aspect of it. But in essence, mortgage rates shouldn't really scare anybody. It comes down to affordability. With regard to comparing, if you're a serious home buyer, then what does it take for them to open up the relationship with you and to get a good overview of what their buying potential is?
I think the most important sentence that I tell clients right up front, either through email or on phone, just to have the conversation, we don't have to run your credit. You don't have to run your credit to have the initial conversation. I could share with you and say, okay, here's the down payment, here's the amount of the monthly payment, and you go, stop. Good, thank you. I'm not comfortable with that. Or that's great. I am super comfortable with that. So let's move forward to the next sentence. And that doesn't take credit to be run. You don't have to have an inquiry on your credit. Now, you should know what your credit is. If you don't, there's different sites online where you can go on, like I think it's annualcreditreport.com, where you can go on as a consumer, look at your credit. You should have an idea of where your credit's at, of course. But I don't have to run credit just to have that initial conversation. And I think that's so important. And one of the reasons is, as you're going out to look at a property, you're cheating yourself if you don't have your qualification in place and have it started. And the cheating isn't because you may not be able to qualify for the property that you love. You may be able to qualify for something that's much better, and the payment may be lower than you anticipate it going to be for something that you really want. So I think the first step is just having the conversation. You know, when I talk to people, we just talk. We just run numbers. I need to know, what is your income? What are your debts? Do you have car payments, credit cards? Do you have student loans? Where's the down payment coming from? Is it a gift? Do you have it in the bank? Families allowed to give gift. Are you looking for one of the grant programs? Are you selling it? Did you just receive it from a sale, an estate, an inheritance? There's so many different ways. Can you borrow from your 401k? Can you retrieve it from an IRA if you're a first-time buyer? These are all legitimate questions and possibilities. So I think that it's important to have that initial conversation. And as again, I said it, you don't have to have a credit inquiry to make that happen. And that just gives you some comfort on where payments are. I've had a lot of people who call back and go, you know what, thank you for that. We did it. We went out and looked at the properties. Can we run numbers again at 200,000 higher? Because, you know, you gave us the number. We really didn't want to go higher in the payment, but everything we're seeing is 200,000 higher. And we know we can qualify for it. Can you just show me the numbers on what they are? You know, and they're willing then to make that sacrifice to make the higher payment to get the home that they want. That happens a lot of times. So I think that you're cheating yourself if you haven't taken that step up front, not from the aspect that, you know, it does anything but gives you confidence as you're going out looking with you to look at properties, Mike, that you can guide them and say, okay, then let's go look at properties in this price range, or this price range, or this area, or this size, or whatever it may be. It helps them, the buyers, to be guided by you on what's really possible and what's comfortable for them on a payment aspect.
Yeah, and that's why, you know, as I started off, successful strategy is one, budget, then the neighborhood, then the structure. The first two can't be changed easily. The structure, you can do modifications, and usually within any neighborhood, you have different levels of structures. So thank you very much for everything you shared. We'll make sure to include the link to the calculator below, as well as your contact information. If you like what you hear, please hit subscribe, like, and share below. And we look forward to our next episode. Thank you very much for your time, Dean.
Thank you so much. Appreciate the opportunity.
Bye.